Step back and see the macro and digest it down to the micro. Trading, investing, and geopolitics from macro down to the micro. Welcome to Macronomics.
Welcome back to Macronomics, guys. Today we're going to be talking about the beauty of letting go early and a little overview of the macro sphere where we're currently at. So with that, let's go ahead and dive in. So we're going to start the picture off with the macro sphere. As of now, just some things that are unfolding around the world politically and that correlates to the macro sphere of trading, economics, money. Right now, so there's a lot of turbulence within Russia. From my observations this morning, the Japanese yen, well, the USD JPY, is continuing to go up. So it just seems like a lot's happening. We're starting to really, move towards something. And I was listening to something yesterday about, essentially the underbelly of this system is credit and how it's just continuing to expand. And, I was looking at the 10-year Treasury bonds and it's slightly up, the 2 years slightly down. I'm still trying to piece all this together, guys. And what I'm learning, if you have any money locked up financially in any soft assets, when I say soft, I mean like IOUs or, you know, um, like anything like that, like a lot in money, I would try to transfer that into hard assets. Now, I'm not saying we need to be worried. It's just things are changing rapidly. And so being aware of that and being able to maneuver with that, I feel is paramount in today's day and age now. So all of these things that are happening, from Europe to the volatility of the dollar compared to other currencies, it's just you know, I remember I told you guys a little bit about Currency Wars, the book I wrapped up. That was the author of the New Great Depression. Forgot his name, but essentially how these currencies, like, they manipulate their prices on their floating exchanges to, because they want their currency to be low so that they can export more. And it's like, if you have everybody doing this, there's no trust in the game. See, that's the whole foundation of these IOUs is trust. And if there's manipulation, especially on the world stage, when the buyers of these large amount of quantity of currencies is other countries, then I mean we're shooting ourselves in the foot. I wouldn't say we. I'd say more like the central bankers and the people who orchestrate these markets. Because, guys, let's face it, these markets are manipulated. Yes, I feel like there's an organicness to it that you have to be aware of and move with, but there's definitely manipulation within it. And so we just had to be aware of that, and we have to move as accordingly. And so what's happening in Europe and around the world and whatnot, let's just continue to piece that together to create the macrosphere. And so that can illuminate some of our trades. Not our trade. We're not trading based on macro news, so to speak. We're not trading based on political news. We're just putting all that together as confluence. Like, I placed a minor trade this morning around pound and the dollar, and the reason being is because of the environment as well as some other confluences. So I'm not taking the trade based off these parameters, but I'm taking that into consideration about the sphere and how things are moving. And so that's just how I go about it personally. That's what's going on now. Let's continue to keep pushing it together. There's a lot of to conclude this segment, guys. There's a lot of talk around rate hikes and interest rates, and I'd highly recommend. Like, I went deep into an article on Wikipedia, just really digesting what interest rates are, and it seems like, not seems like, but from one piece of information that stuck out that was interesting was negative interest rates creates what was it? Negative interest rates creates where I think where you owe money. I believe it was that. But anywho, the interest rates, guys, just definitely continue to illuminate your perspective on that subject, because that's what governs a lot of these banks and how they maneuver is interest rates, which is essentially how much they charge, I guess, for lending out money. And then that will take you into the granular aspects of reserves, like how these banks use their reserves to facilitate, and it's a lot, guys. And just continue to piece that together, because that will help gauge and put together your macro perspective. Now, down to, let's get a little bit granular here, get down to the micro. So, past week I've been implementing some heavy. I told you guys about the book, The Best Losers Wins. And it's such a great book, essentially, how to lose, and, also some technical aspects as well. And so we've been implementing some recently with two trades. We so we placed the trade, right, and like we always talk about, guys, it's not about you know figuring out what is figuring out where the instrument's moving. It's about probabilities and placing the dominoes, but also being agile enough to switch, not being rigid in your approach. You can't be rigid in the markets. You have to be like water, and you got to flow. And so, long story short, I placed two trades, and I actually built on the position, right? I came back the next day. It slightly moved against me, right? Now it was nowhere near my stop loss, but here's what I did. I cut it. I cut it. Here's why. I want to implement something and go against the grain of the mental psychology that we're prone, or at least in me specifically, I'm prone to. See, I'll leave trades open, and I've watched them before. I've I'll leave trades open just for them to close when they're continuing to move in that direction. I'm like, well, it didn't hit the stop loss. If it doesn't hit stop loss, I'm gonna just leave it open. Here again, guys. Being agile enough, it's not about predicting where the instrument's going. You place the parameters. Guess what? You're catching a wave. You're like a surfer. You want to ride the wave. When the wave is swelling, that's when you want to swim out. If there's a wave that is swelling, but then it turns out not to be a wave, are you gonna keep paddling out, using your energy and your resources when the wave's not there? And so, for me, being able to create and identify these parameters around a swell, so to speak, and for me, going back into the trade, seeing the swell wasn't there, I'm hopping back out. Because if we can continue to gauge and put together parameters so that we can identify these swells, ride the waves, minimize our risk, then we have a lot of upside and a lot of and minimum downside. And so with these two trades, guys, I think $11, right? $11 was what I risked, not risked, what was lost, quote unquote, right? It wasn't really lost, it's part of the game. But that compared to, I think it was maybe 60. But again, guys, think about it. If I'm capping the loss, right, and leaving it there, and then waiting to find another entry point and another swell point, I like that. We might have to uh, trademark swell. You want to find the swell and ride the market. Ride the market. If the swell is not there, get out. Do not sit and wait, because I've just from personal experience, guys, I've noticed, these trades, those trades would have added up to like, you know, $60 when I'm sitting there. See, the reason it's arbitrary in its approach. You leave the stop loss open. Why? Because you're rigid. At least I am. I'm speaking from myself's perspective. I'm rigid in the approach that I've set the parameters that I believe the market should go, and I'm gonna leave it open until it proves otherwise. I'm not agile. I'm not moving with the market, guys. The market is a moving, breathing entity that is constantly changing. And it's not about predicting, it's about probabilities. And when you do get that wave, when you finally get that wave, and then, I maybe add to the position, like some of the parameters we talked about in the book. This is what we're currently experimenting with. You find the wave, and then you ride the wave. You build on the wave, right? You of course manage your risk. You do all those parameters. But now you ride this wave and it's exponential. It's exponential. But the key is you got to be agile, and at least that's what I've been learning from this. And I feel good closing those trades, guys. I look back, I believe it was the Australian dollar and the U.S. dollar, and it looked like it did move in my direction, but I wasn't able to record the specific parameters that we got out at, and so it looked like it did continue to move in the direction I initially was in for. But guess what? I don't feel a twinge of loss. Here's why. Because you are creating the the psychological components that is going to allow you to be successful in the markets. Naturally, humans do not have the natural psychology to be in the markets. They're risk averse, and like they're fearful when they should be. I mean, I know you've heard this: fearful when you should be greedy, and greedy when you should be fearful. So flipping that on its head, if people are in a trade, right, they're hopeful that it will turn around. That's a natural psychological component. So what I've been trying to do is turn that on its head by instead being greedy when the market has identified that it's moving in a good direct, not good, but the parameters that I set, and being fearful when it's not. I don't have to wait for it to reach my stop loss to identify this is not how I want to move. Because remember, those parameters that you set are arbitrary in its approach, meaning it's random. The market does not adhere to what you put on it. So that stop loss is arbitrary in its sense. If it moves against you, get out. Identify these parameters. Like I personally place channels within, like, if I'm selling something, right, and my stop loss is to the upside, then I'm gonna have channels towards the upside where I want to get out, because I don't have to wait until it gets to the stop loss. I can now, of course, that's the minimum. Like, if I'm not near the charts and it reaches that point, boom, okay, I'm okay with that. But if I get in a trade and it's touched one of those points, then guess what? I'm out. Now, if it's moved to the downside and I'm able to identify the parameters around this, and again, this is where it gets granular in your approach, then maybe you can salvage this trade. Maybe you can maneuver with it. But the key here, guys, is agility. You must be agile in your approach, because if not, you'll get stuck trying to, conform the markets to your view, predicting. Be fearful or be greedy when others are fearful, and be fearful when others are greedy. Why do 90% of the traders fail? Supposedly, that's the statistic. It's because 90% of them, I'm pretty sure, have common things that they're doing. And what are those common things? It's what you've been doing. It's what I've been doing. It's what our natural inclinations are. See, the reason why most people won't succeed in these markets is because they're not open to change. And trust me, I've went through this phase, and sometimes I still go through this phase. It's a phase of failing, and then looking on the outside, consuming as much information from books, charts, indicators, and it's you swell up all this information. But guess what? You're not changing the fundamental basis of your approach, which is how you're approaching the markets and how you're trading exactly from to the granular. Just some food for thought, guys. Be agile in your approach. Be agile. Ride the wave. Catch the wave. Identify the wave. Have parameters in place to make sure it's a wave. And then get on that motherfucking ride it. Ride it like you ain't got no tomorrow. And when you come down from that wave, when you come crashing down, right? It's going to be the best feeling of your life. Riding the wave. Ride the wave, guys. Ride the wave.